Quickly before we get into this crazy week of the stock market, I'm taking next week off for Christmas, so my next video will be in 2 weeks. I'll also take that time to put our technology portfolio on our website. So, about stocks. Things are certainly getting interesting in the stock market. For the first time in 50 years, the Dow Jones Industrial Average fell for 10 consecutive days. On Wednesday, the Federal Reserve cut interest rates by 1/4 point, which is a good thing and was pretty much expected. But then the Federal Reserve said there would be fewer cuts, interest rate cuts, than many had expected for 2025, and investors did not like that at all. So far, December has not been good, despite December usually being the best month of the year for stocks. Now the Dow almost fell for an 11th consecutive day, but on Thursday, the Dow index eked out a minuscule gain of 0.04% for the day. So we avoided an 11th consecutive day of down in the Dow. Then on Friday, the Fed's preferred measure of inflation, called the Personal Consumption Expenditure Price Index, PCE, showed that inflation has slowed more than expected, of course, which is a good thing. And many investors were happy as S&P 500 finished up for Friday. However, it was down for the week and is down for the month of December. So what does this mean for our classroom stock portfolios? There are now many more bargains to buy, that's for sure. So we're getting some good prices. Our classroom stock portfolio of high-yield, dividend-paying companies now has an annual return of 23.1%, and it's beating the S&P 500 since the portfolio started. And our dividend-growth stock portfolio has an annual return of 18.12%. It was started 20 months before the high-yield dividend portfolio. But our best performing portfolio so far has been our technology portfolio, which is an annualized return of 41.96%. It has only been in existence since April of this year, so its return will likely fluctuate a lot, and it's very volatile. Later in this video, I'll discuss ways to potentially boost the return of our stock portfolios, but it will require giving up some portfolio diversification. But depending on how much diversification you require, that might be relatively easy for some of you to do, as our dividend-growth stock portfolio currently has 104 holdings, our high-yield portfolio has 31 holdings, and our tech stock portfolio has 24 holdings. So what is this slide showing? It's showing the portfolio value over time for our main portfolio, which invests almost exclusively in dividend-growth stocks. As a class project in 2022, we started investing $12.50 each week into the portfolio, and it's now worth over $2,640 after 155 weeks. Each week we take that deposit and split it up to buy 10 different dividend-paying stocks. So we are buying fractional shares of stock. Each week we re-rate the stocks, so the list of top stocks fluctuates from week to week, especially when it's earnings season, which will start halfway through January. And in August of last year, we started a second portfolio, this time investing in high-yield dividend-paying stocks. Now on this graph, the tan line on the chart shows what the portfolio value would be if we'd instead put the money into a savings account. In our first year, 2022, stocks did not do well. As you can see, our portfolio had overall losses where the blue line falls below the tan savings account line. But the power of compounding is working in our favor as the portfolio really took off in November 2023. I'll also update our tech stock portfolio towards the end of the video, which has only been in existence since April this year, but has been the best performing portfolio over that time. And for those that have been asking, I put the dividend-growth stock portfolio and the high-yield stock portfolio on that website, which is beatthestockmarket.com. And over the Christmas break, I'll be putting our tech stock portfolio up on the website. Hi, Professor Rex here. If you're new to my channel, I teach college accounting, and I often show my students how to use the accounting concepts that I teach to pick stocks because it gets the attention of my students and keeps them engaged. To show them accounting concepts in action, starting in 2022, we started a class project in which each Monday I invest actual real-world money, $12.50 per week, which is roughly the equivalent of $50 a month, into 10 different dividend-paying stocks. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is doing. Also, viewers can use our progress as inspiration for their savings goals and get ideas of company names that they can do their own research on. There are timestamp links in the description of the video in case you just want to jump to the list of stocks we bought last week or the list of our best performers or any other section of the video. In 2022, the year we started the dividend-growth portfolio, the market did not perform well, and neither stocks nor bonds. But because I don't believe in trying to time the market, we kept buying each week at what turned out to be great prices. Then in 2023, stocks took off. Currently, the portfolio's value is over $2,640. The portfolio's return has been 18.12%. Last year, the portfolio's return was 28.6%, which beat the S&P 500, and the preceding year, the portfolio once again beat the market. Before we get into which stocks we bought this week, a lot of people have been asking me for my favorite books about investing. My two favorite books were the basis for the 3 stock screens I publish monthly on our website, which can be seen on this slide. My favorite investment book is called What Works on Wall Street by Jim O'Shaughnessy, whose investment firm managed over $6.4 billion of investments when he retired. The book is the basis of 2 of the 3 stock screens I publish on my website, beatthestockmarket.com. The stock screens are called the Trending Value Stock Screen and the Consumer Staples Stock Screen. I update the stock screens monthly, but first of all, what is a stock screen? It's a set of criteria used to narrow down a large list of stocks to a smaller list of stocks in which you can invest in or do further analysis on them. The book examines various ways to tell if a stock is undervalued by examining simple metrics like the PE ratio, which stands for price to earnings, dividend yield, etc., as well as combinations of those simple metrics. There are a lot of tables and graphs, so if you're a numbers geek like me, you'll probably like the book. It also talks about the history of the stock market and the psychology of investing, which is also fascinating and cannot be understated. The other book I recommend, especially for younger investors, was written by the son of the author I just mentioned. It's called Millennial Money and is the basis for the Millennial Money stock screen that we publish monthly on our website. Of course, you can follow the book and just recreate the screen on your own if you're into numbers and Excel and stuff like that. It's a much shorter book than What Works on Wall Street. I've got some links to the books in the description of the video for you to check out. Since we are now in the month of December, let's take a look at the historical performance in the month. Now remember, these are averages, and so far December is bucking the odds, so this kind of gives you a good example of what averages are. There's always going to be exceptions. So according to the Center for Financial Research and Analysis, December sees the largest average stock gain of all the months of the year since World War II. It also has the highest percentage of gains of all the months of the year. And it also has the lowest volatility of all the months, with nearly 40% less volatility. And then there is a Santa Claus rally. According to Investopedia, the founder of the Stock Traders Almanac coined the term Santa Claus rally in 1972. He defined the time frame of the final 5 trading days of the year, so this is coming up, and the first 2 trading days of the following year as the dates of the rally. The Stock Traders Almanac compiled data during the 73 years from 1950 through 2022 and showed that a Santa Claus rally occurred 58 times, or roughly 80% of the time. So basically, December is historically the best month of the year for stocks, and especially in that last week, we usually get some good gains. Theories that explain a Santa Claus rally include end-of-year tax considerations, a general feeling of optimism and seasonal happiness on Wall Street, and investing holiday bonuses. Some institutional investors, the big boys, settle their books and go on vacation during this time of year, leaving the market to retail investors who tend to be more bullish toward the market. The Center for Financial Research and Analysis also had a list of the best performing sub-industries in the month of December since 1990, and those sub-industries are home building, healthcare facilities, building products, home improvement retail like Home Depot, and hotels, resorts, and cruise lines. Because we are investing additional funds each week into most of our model portfolios, the way to calculate portfolio performance becomes a bit more complicated. The formula that is most commonly used to calculate portfolio performance is called XIRR, or Extended Internal Rate of Return, and we use it too. It's the same formula used to calculate portfolio performance in Quicken, the personal finance software. You can see the formula at the bottom of the screen. You can calculate it by hand if you like, but if you want to maintain your sanity, you're better off using Excel to calculate it for you, and then use Quicken software to double check it if you really want to be sure, which is what we do. In this video, we talk a lot about our dividend growth portfolio and our newer high yield portfolio, which is geared more towards those nearing retirement. The table at the bottom of this slide shows a portfolio comparison when both portfolios existed. Because remember, the dividend growth portfolio was started 20 months earlier than the high yield portfolio. The high yield portfolio was started in August of 2023, and the annualized return so far is 23.1%, which is surprisingly higher than our dividend growth portfolio, which has an annualized return of 18.51% over the same time period, which includes way more growth stocks than the high yield portfolio. I expect that the dividend growth portfolio will eventually have the higher return over the long run, especially since the high yield portfolio has less than 0.5% of the portfolio in tech stocks. But time will tell. If an investor was solely investing in the high yield portfolio, I would think about supplementing it with some tech stocks for additional diversification. On our website, we have ideas for technology-focused investments that provide income, ranging from dividend growth stocks to closed-end funds and ETFs. Now remember, the high yield portfolio has only existed for nearly 16 months, so its annual return will likely jump up or down to a greater extent than our dividend growth portfolio's return. The fact that the high yield portfolio is outperforming our dividend growth portfolio over the same time period is pretty surprising to me, but we're finally seeing the difference start to narrow. This slide shows the cumulative growth of the dividends we've received in our dividend growth stock portfolio. Our dividends for the latest month increased 53% over the same month a year ago, and our dividends for the latest quarter increased 130% over the same quarter a year ago. The graph shows how quickly the dividends are growing and is a great example of the power of compound growth. Albert Einstein is widely rumored to have called compound growth the most powerful force in the universe. So why do we only invest in dividend-paying stocks in our two main portfolios? The first reason we stick with dividend-paying stocks for our dividend strategies is, according to Hartford study, over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.17% per year, but for non-dividend-paying stocks, average return has been much lower at 4.27%. The study is updated each year and was recently updated to include the last year, so go check out the source link that I included at the bottom of the screen. Morningstar also recently released a report that went all the way back to 1927 and came up with the same conclusion. Dividend-paying stocks have a higher return and less volatility than non-dividend-paying stocks. That second point about having less volatility is probably even more important than the fact that dividend-paying stocks have a higher return. Why is a lower amount of volatility so important? Well, it's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. So remember, our tech stock portfolio has the highest return so far of our portfolios, but it is also the most volatile. Some people can't handle that, so you need to be careful. So why are dividend-paying stocks less volatile on average? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks as measured by beta and standard deviation tend to be much lower for dividend-paying stocks, and that's a good thing. And finally, the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom portfolio only invests in dividend-paying stocks that have increased their dividend recently. Along the same lines, BlackRock recently released a report showing that $10,000 invested in companies that grow their dividends, in other words, a dividend grower is a company that has raised their dividend recently, and dividend initiators, that's a company that just started paying a dividend, grew to 2.6 million versus 1.6 million for the S&P 500, a difference of 62.5%. Now that's not the best comparison because S&P 500 includes both dividend payers and non-dividend payers. So a better comparison is just to the non-dividend payers. So that same $10,000 invested into non-dividend paying stocks only grew to 1.2 million. So stocks that raised their dividends or started paying a dividend beat the stocks that did not pay dividends by 116.7%. Now the holy grail of dividend investing is having a stock portfolio that produces two things: a growing stream of income that produces enough income to cover your expenses plus extra cash to cover travel, vacations, luxury purchases, etc. And two, also produces a growing stream of income that also grows faster than the rate of inflation. And dividend-paying stocks historically increase their dividends significantly higher than the rate of inflation. This means that quality dividend-paying stocks can provide a growing income stream for a lifetime. Now, this is in contrast to bonds, which do not raise their payments to bondholders. Here are two examples of stocks growing their dividend payouts over the years. The first stock is Broadcom, which just increased its dividend for the second time this year and for the 14th consecutive year. I bought Broadcom, a chip maker, in 2020, just 4 years ago, from my taxable account. At the time, its yield was 5.01%, meaning for every $100 I invested in the stock, I would receive $5.01 each year. The company has quickly grown the dividend to the point where the yield, based on the original investment, is now 9.14%. And remember, that's only 4 years later. So imagine if this keeps up, how much it'll be in the future. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen so much. That's why it's important to invest early and be patient. And I fully expect Broadcom to continue to increase its dividend well into the future. And if not, that's why we have constructed a diversified portfolio. That's the power of investing in quality dividend growth companies. My second example of a high quality company with a history of raising its dividends is Home Depot. In 2003, when I was attending college, I had started a dividend stock portfolio for the investment newsletter I had started at the time, and Home Depot was recommended for that portfolio and is still in the portfolio today. At the time, its yield was a low 0.83%, meaning for every $100 I invested in the stock, I would receive only 83 cents. Seemingly not much to get excited about. But over the years, Home Depot has grown the dividend to the point where the yield based on the original investment is now 31.1%. And like Broadcom, while there are no guarantees, I fully expect Home Depot to continue to grow its dividend well into the future. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen. Again, that's why it's important to buy early and be patient. Now remember, stocks historically have a higher return than bonds and are also riskier than bonds, but you certainly will not find a bond that pays anywhere close to the yields on the original investment that these two stocks are paying. And bonds don't increase their payouts to investors like stocks can and often do. Another reason to own dividend-paying stocks is for the potential to generate up to $126,700 of tax-free income each year if you're married and filing jointly. Remember, the ultimate goal of dividend investing is growing your portfolio to a point where it generates enough income each year to live off the dividends. And because companies historically increase their dividends above the rate of inflation, you have the ultimate income stream that not only covers your expenses but grows over time. And if you're married and filing jointly, you can make up to $126,700 in qualified dividend income and pay zero federal tax on those dividends if you have no other income. That's perfect for retirees. If you're single, that amount is $63,350. Those amounts usually increase each year as the standard deduction increases and the tax brackets are adjusted. And they did increase in November, just last month. So how are those amounts calculated? First, you find the 0% tax bracket for long-term capital gains. And then find the standard deduction, which can be located in IRS Publication 505. As you can see, for 2025, the standard deduction increased in November, meaning that you can potentially earn even more tax-free income from qualified dividends than you could in 2024. Then the final step is to take the 0% capital gains amount and add it to the standard deduction, which means we get a final amount of $126,700 that a married couple filing jointly could generate an income from qualified dividends that would be federally tax-free. So why do we choose to start investing in our model stock portfolio with only $12.50 per week, which is essentially the same as $25 per paycheck? I personally am investing a lot more than that in these dividend strategies in my other portfolios. But for our classroom model portfolios, the main reason we started with a very low weekly investment amount is because I wanted to show my accounting students that you don't need much to build a diversified stock portfolio. In fact, when I was only making $11,000 per year as an enlisted member of the military before I got my degree, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because my brokerage account, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. Originally, I invested $25 per paycheck, but found the process to be so fun that I split it up and now invest $12.50 each week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation. So when your paycheck increases, that means you should increase the amount that you're putting in your 401k too. By the way, I also invest in these same stocks in my retirement account and my taxable brokerage account. Research we discuss in class is the same research I use for myself. Another reason I started with a low investment amount was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assumed the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invested an additional 35 cents each week for a total of $12.09 per week instead of $11.74. Now for our classroom dividend growth stock portfolio. In year 2, we boosted the weekly investment 82 cents for a total of $13.32 per week. Inflation was high that year, so that's why it's a higher amount. In year 3, inflation was not quite as high, so it wasn't even close to being as high. So we boosted the weekly investment by only 49 cents for a total of $13.81 per week. Now, a very popular exchange-traded fund that only holds dividend stocks is called the Schwab U.S. Dividend Equity ETF, ticker symbol SCHD. SCHD is a large holding in my personal account, so I've been tracking SCHD's performance closely with our 2 dividend-paying stock portfolios. As of today, our dividend growth classroom stock portfolio's annual return is 18.12%. If we had instead invested the same exact amounts into SCHD on the same day, the portfolio's return would only be 8.78%, a difference of 106.4%. Our high yield portfolio is also outperforming SCHD, but by an even larger amount. Obviously, there's no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting in our 2 dividend-paying classroom stock portfolios. I also prefer our actively managed classroom stock portfolio strategy rather than SCHD's purely algorithmic approach where no one is overseeing the stock selection. It's just an algorithm picking the stocks. SCHD has at times had large positions of stocks that I consider to be value traps, and that's not a good thing. Now this slide shows our best performing stocks in our various portfolios based on when they were initially purchased. This includes all 4 of our portfolios. But as you can see in the upper right, the dividend growth stock portfolio was started much earlier than our other portfolios, which means the stocks in the portfolio have had much more time to see their prices rise. Therefore, this list of best performing stocks thus far will be dominated by our dividend growth stock portfolio, at least for the time being. For example, our tech stock portfolio has been our best performing portfolio on an annual basis so far, but because it has only existed since April of this year, so only one of that portfolio stocks has made the list so far, with that being Shopify at number 15 with an 86% return in less than 7 months. Of our 2 dividend portfolios, our best performing portfolio thus far on a per year basis is the high yield portfolio, but it only has 1 stock on the list so far because the portfolio was started 20 months after the dividend growth portfolio. It also holds far fewer stocks in our dividend growth portfolio. Now stocks in yellow like Evercore and Crane Holdings have been sold. Our best performing stock so far has been Broadcom. So far, it has provided our dividend growth portfolio with a 295.7% return in less than 3 years. It was also purchased later for our tech themed portfolio and is number 6 on the list with a 105.2% gain in less than a year for our technology themed portfolio. Evercore, an investment bank, is at number 2 with a 252.9% total return. It has been sold. The fastest risers that are still in the portfolio are NVIDIA in our technology themed portfolio with a total return of 179.8% in less than a year. Shopify, which has almost doubled in 6 months. Well, actually, it almost doubled like 2 weeks ago. Now it's come back to earth a little bit. It's only up 86% in a little more than 6 months. And Bank of New York Mellon has an 89.8% return in less than 15 months. And that's for our dividend growth portfolio. And remember that total return includes both the dividends the company has paid as well as the increase in their stock price. Here's the usual disclaimer. This presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own due diligence. So for our dividend growth portfolio, well, first of all, this slide is talking about stocks we sold last week. For our dividend growth portfolio, last week we sold NASDAQ, ticker symbol NDAQ, which provided a total return of 59.2% in a little less than 18 months, giving us a 36.4% annualized return. We sold NASDAQ because the stock looks to be fairly valued, plus the stock's four-way rating, which includes valuation, quality, past dividend growth and current yield, and future dividend growth potential, has fallen to the bottom 30% of stocks, limiting its upside. And we also sold Interpublic Group of Companies, ticker symbol IPG, which is an advertising agency. We sold IPG because the company has agreed to be acquired by Omnicom, which is ticker symbol OMC, in an all-stock deal valued at $14.8 billion, including debt. Now, each share of IPG will be exchanged for basically a little more than a third of a share of OMC. The deal values IPG at $32 a share, which was a 10% premium prior to the announcement of the takeover. The deal combines the third and fourth largest ad companies by revenue. IPG has had significant challenges from its competitors in online advertising, and those being like Meta and Amazon, the latter of which derives a lot of ad revenue from its product listings. IPG has performed poorly for the portfolio, returning negative 1.2% in 6.9 months. For a high yield portfolio, we sold Cheniere Energy Partners, providing a total return of 23.5% in 8 months, which is an annualized return of 35.8%. We sold Cheniere because the stock appears to be a bit overvalued, and the stock's four-way rating of valuation, quality, past dividend growth and current yield, and future dividend growth potential is now in the bottom 31% of stocks, limiting its upside potential, just like NASDAQ. And we also sold IPG for the high yield portfolio, and it gave the high yield portfolio a slightly better return than it did for our dividend growth portfolio. It eked out a positive return of 0.9% in 7.4 months. Now on to stocks we purchased last week. 90% of our portfolio is comprised of high-quality dividend growth stocks, but the other 10% or so is invested in under-the-radar dividend payers. Now, an under-the-radar dividend payers, a company that has recently started paying a dividend, and we're hoping that they will eventually grow into being a dividend growth company. Now, last Monday, we bought an under-the-radar dividend payer called GE Verona, ticker symbol GEV. The company, which recently announced it will start paying a quarterly dividend, is a global energy solutions provider operating in the areas of power, and that's primarily gas turbines, wind turbines, and electrification technologies. The customers of the company generate approximately a quarter of the electricity in the world today. So it's not a tiny company. And another under-the-radar dividend payer we bought last Monday is called Match Group, ticker symbol MTCH. The company, which recently announced it will start paying a quarterly dividend, is a leading global provider of dating services with over 15 million paying users, and its portfolio includes companies such as Tinder, Hinge, and Match. Now let's talk about the dividend growth stocks we bought last Monday for our dividend growth portfolio. Here are my ratings for the top 15 dividend-paying stocks last week, but remember we only buy 10 per week, so we're buying the first 10 on the list that are not in yellow. And if they are in yellow, that means the stock is not going to be bought because it has an allocation of 4% or greater of the portfolio. We don't want to get top heavy in a company like Microsoft or anyone else. So Thermo Fisher and Lam Research both remained at the top of our listing. Remember, we use many criteria to filter stocks, and if a certain stock is hovering at a required level or near a required level, they can make the list one week and then drop off the list based on a small movement in that metric. Examples of criteria used to filter out stocks include required margin of safety and consensus earnings growth estimates over the next 12 months, which changes frequently. For consensus earnings growth estimates, I will only purchase a stock if its earnings are forecast to grow at least 5% over the next 12 months. That's because we want to invest in stocks that can continue to raise their dividends. So a stock might have a 5.2% estimate one week and make the list, but the next week its estimate could dip to 4.9%, which means that the company suddenly doesn't make the list at all, because remember, we require 5% or better. This is just one of many filtering criteria we use to narrow down our list of investable stocks. So like I said before, each week we buy 10 stocks, and since we're investing such a small amount each week, it means we're buying fractional shares in our Fidelity brokerage account. And for those that have asked, we do not automatically reinvest dividends into the same stock from which the dividend was paid. Instead, each week when we're buying the 10 stocks as shown on this slide, we combine the weekly deposit with the dividends that have been paid that week and are sitting in the account as cash. We then take that combined total and split it up amongst the 10 stocks that we're purchasing that week. In other words, we reinvest dividends weekly into the 10 stocks we were purchasing that week. Now, for the sake of convenience, there's nothing wrong with simply turning on your broker's auto reinvest feature, but we think it's more ideal to reinvest in our top stocks each week instead of potentially reinvesting in a stock that is fairly valued as opposed to undervalued. The table on this slide includes the company's sub-industry, how undervalued they are according to our research, their risk ratings, quality grade, and dividend yield. The most undervalued stocks last week appeared to be Thermo Fisher, Huntington Ingalls, Nike, and Microchip. Remember, all these stocks pay a dividend and have recently increased their dividends, and our methodology used here indicates they're likely to continue to raise dividends, therefore this is a dividend growth strategy. Also remember, this dividend growth stock portfolio is in a brokerage account separate from my regular brokerage accounts to make tracking this portfolio easier. So my other brokerage accounts, I'm also investing in these dividend growth stocks and the high yield stocks and the tech stocks in our other portfolios. Last week I purchased over $2,800 of the stock from those three portfolios as I reinvest dividends and gradually transfer out of my main dividend ETF, that being SCHD, and buy these stocks instead. I'm also trying to tweak the buying strategy a bit to see if I can boost returns. I'll share the results with you once I have enough data, and in my next one or two videos I will talk about a new strategy we've been successful with that we'll start a new portfolio with. All right, on this slide I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 90% or so of our purchases. The other 10% or so have been invested in smaller, under-the-radar companies that have recently started paying a dividend, like Match and GE Verona. These under-the-radar dividend-paying stocks tend to be riskier because they are often smaller companies. Not always, but often are. But studies have shown that they historically beat the market averages by a significant amount. Risk is the first quality component on this slide, which we mentioned in the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported profits. And finally, the last quality component is financial health. If you're looking for lower risk stocks, and a lot of dividend investors prefer lower risk stocks, I would suggest looking at Nike, West Pharmaceuticals, Microsoft, General Dynamics, and Taiwan Semiconductor. Remember, the risk rate is comparing these stocks to other stocks, not to other investments like bonds or CDs. The companies earning the highest financial health ratings are Thermo Fisher, Applied Materials, Microsoft, and General Dynamics. Now let's look at the dividend growth grades of the companies. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. As you can see under the grade called Grade for Recent Dividend Growth and Current Yield, the stocks with the best combination of dividend growth and a higher yield are Lam Research, KLA Tencor, Huntington Ingalls, and Microchip. All of these earned an A- or better grade. Ideally, you want a higher dividend yield, high recent dividend growth, and the best potential for future dividend growth, but that's not the way it works. Companies that are already paying out higher dividends rarely have the greatest potential for the greatest growth in those dividends. In our list, as you can see from the last grade called Dividend Growth Potential, the companies in the best position to increase their dividends substantially are Thermo Fisher, Applied Materials, West Pharmaceutical, and HCA Healthcare. These earned an A- or better grade. The companies with the best combination of recent dividend increases and potential of future dividend increases are Thermo Fisher, Lam Research, Applied Materials, and KLA Tencor. Here are our trade confirmations from last Monday for the dividend growth stock portfolio. We took the weekly deposit plus any dividends that had recently been received, plus the proceeds from selling NASDAQ and Interpublic Group, and then invested the total of the then reinvested that total, hard for me to say, in the top 10 stocks in our buy list from the previous slides for the week, as long as they don't have a portfolio allocation of 4% or greater. Now let's talk about ways to potentially increase the return of our dividend growth portfolio. For those that are okay with giving up some portfolio diversification, I believe there are 4 potential ways to boost the portfolio's returns. Each week we buy 10 different dividend-paying stocks ranked 1 through 10. On average, the stocks in positions 1 through 5 outperform the stocks in positions 6 through 10. Therefore, the first way to potentially boost portfolio returns is to buy only stocks in positions 1 through 5 or something like 1 through 6, 1 through 7, whatever you want. However, the downside is this reduces the portfolio diversification. But some investors are comfortable with a more concentrated portfolio. So far, investing in only stocks ranked 1 through 5 would have improved annual returns 70%. But I personally prefer a more diversified portfolio, since the goal of my dividend portfolio is to live off the dividends. Option number 2, you could try not limiting individual holdings to 4% of the portfolio's total value. Normally, if a stock's allocation of the portfolio is 4% or greater, like Microsoft from a previous slide, I won't purchase more of that stock. This technique reduces the portfolio's risk by ensuring the portfolio doesn't become heavily weighted in 1 or 2 stocks. I purposely created this portfolio so it would be very diversified, because the ultimate goal of dividend investing is to have the dividends cover all of your expenses plus generate extra income for vacation, travels, etc. I am a conservative investor, and I'm personally investing a lot in these dividend portfolios, so I want to make sure the portfolio is not only well diversified between sectors, but also between industries and even sub-industries. That way, when the inevitable dividend cut happens, it doesn't affect one's cash flow in a major way. However, an investor who has a higher risk tolerance and therefore doesn't mind a more concentrated portfolio might try removing the 4% limit in an attempt to boost the portfolio's returns, especially if the company in the top 5 of that week's rankings is mentioned in the bullet point 1. So far, not limiting individual stock positions to 4% of the portfolio would have improved annual returns by 58%. But again, I personally prefer a more diversified portfolio. So it all depends on your risk tolerance. Number 3, the under-the-radar dividend payers, despite having some incredible performers like F&G Annuities 119% gain in 12 months, and Repositrax 97% gain also in 12 months. On average, they've not performed quite as well as the dividend growers in the portfolio. So skipping the under-the-radar dividend payers is an option to try to boost portfolio returns. One possible reason these stocks haven't done quite as well as the dividend growers is because many of the under-the-radar stocks are very small companies, and small stocks have not performed as well in recent years. Large stocks have dominated. Like the previous strategies, this method reduces portfolio diversification. And number 4, you could try selling when a stock is fairly valued, even if dividend quality metrics are excellent. So we don't sell often in the portfolio, definitely not weekly for every portfolio, and tend to only sell if the company cuts the dividend or the stock appears to be overvalued or the company's dividend quality metrics fall out of the top 50% of companies. In other words, if a stock appears to be fairly valued but the dividend and quality metrics are still good, we usually will not sell the stock just because it's fairly valued. But if you have your own valuation methodology and it signals that the stock is fairly valued or even overvalued, you might try selling at that time and reinvesting in that week's top 10 stocks that we are buying. The downside would be higher turnover, but this could boost your portfolio's returns by not holding on to fairly valued stocks. If you try this, I'd be very interested to hear your results. Of course, this 4th strategy is the most difficult to implement because you have to implement your own valuation methodology. And for those looking for a less hands-on approach, let's talk about some options to potentially simplify things. For our model portfolios, we invest weekly, but there's no hard and set rule that says to do that. Most people invest with every paycheck, meaning that most people have funds taken out of their paycheck, which is usually every other week, and it's automatically invested in their 401k. When I started our dividend growth stock portfolio, I originally invested $25 each or every other week instead of $12.50 every week. I only switched from every other week to weekly because I found the process to be fun. The advantage of investing every week as opposed to every other week or monthly is you get more diversification. So if one does not mind less diversification in their portfolio, option 1 is to invest every other week or monthly instead of weekly. Option 2 is to just buy the high quality stocks, meaning those with a quality rating of B- or better, and hold forever. Over time, some will turn out to be clunkers, but they will just become very small parts of your portfolio as you let your winners run. On this slide, we're looking at our stocks that have raised their dividends recently. The holy grail of investing, remember, for dividend-paying stocks is to have the portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a teacher salary. Historically, dividend-paying companies raise their dividends by 5 to 6% per year, which is above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. Now, last week, MasterCard announced another substantial dividend increase, this time by 15.2%. So the last 22 dividend increases for the portfolio have an average of 10.1%. This slide shows stocks in our portfolios that have chosen to split their stocks. Since we keep track of every individual purchase in Excel, it's important that we have this slide to remind us to go back and adjust the purchase price, shares held, and dividends per share that we received once the stock split has occurred. The most recent stock split was Palo Alto Networks, which split 2-for-1 on December 16th. Here's a look at the 10 stocks that make up the largest portion of the dividend growth portfolio as of Friday after the market closed. Visa moves to the top spot with 3 of the first 4 slots going to credit card companies. So those of you who are paying interest on your credit cards, we thank you. Remember, our goal is to build a conservative and diversified portfolio by limiting the amount we invest into one single company. Aggressive investors might not want to limit the investment into any one stock. But I'm a conservative investor, therefore we temporarily stop investing in a company if they make up more than 4% of our portfolio. This technique leads to a less risky, more diversified portfolio. It's true that our portfolio's returns would likely be higher if we always invest in our top 10 stocks regardless of the size of the stock's portfolio allocation. But that also creates a more concentrated and more volatile portfolio, and many investors cannot psychologically stick with a volatile portfolio. Volatility often causes investors to panic and sell at the worst time possible. And a lot of times you don't know how tolerant you are to risk until the market crashes. And the market crashes every few years. It's just the way things work. And when the market crashes, that's the best time to be buying, not selling. So our portfolio holdings are currently at 104, with 89% of the weighting of the portfolio being in high-quality dividend growers and 11% of the portfolios being in the under-the-radar dividend payers. We usually make far more additional investments into the dividend growers than the under-the-radar dividend payers. So far, around somewhere between 100 to 105 stocks seems to be the natural limit for the portfolio, as there are only so many quality dividend-paying companies that are trading at a discount. Now, that might seem like a large number of companies to keep track of, but the spreadsheet we've developed for tracking the companies makes it obvious when to sell a company once we download company financial and accounting information in the spreadsheet, which we do at least weekly, and doesn't take that much time. The thing that did take a lot of time was creating the spreadsheet. It took about 2 years of hard work. All right, next slide. On to our high-yield dividend-paying stock portfolio. I've had several older students who are closer to retirement take my classes. They are more interested in stocks with higher dividend yields and asked to start a portfolio using a strategy featuring stocks with higher yields than the stocks in our dividend growth portfolio. So in August of 2023, we started investing $12.50 each week into a separate portfolio featuring stocks with higher dividend yields. The portfolio as a whole has an annual return of 23.1%. Since the portfolio has been in existence for nearly 16 months, that return will likely fluctuate a lot more than the return of our dividend growth portfolio, which was started 20 months earlier. Currently, the high yield portfolio's dividend yield is 4.4%, but the companies in it likely will not grow their dividends as much as the stocks in our dividend growth stock portfolio. Therefore, this portfolio would be more geared toward investors closer to retirement. Having said that, many stocks in the portfolio have increased their dividends, pushing the portfolio's yield based on the amount we have invested to 5.11%. Now, 2 strategies are being implemented in this portfolio, as you see in the next few slides. Strategy 1 emphasizes a high dividend yield over dividend growth. Strategy 2 also features stocks paying higher dividend yields, but places a bit more emphasis on recent dividend growth than Strategy 1 in an attempt to try to get the best of both worlds, that being high yield and dividend growth. Strategy 2 has been the better performer so far. The average investment in Strategy 2 has provided a total return of 16% and has been held for an average of 194.6 days so far, which is an annualized return of 32.12% using Excel's rate function. Now, it's not likely that the portfolio can keep that high of a return since stocks average about 9 to 10% per year historically. On this slide, we're looking at our high-yield dividend-paying stocks we bought last week. Because we had a lot of funds to reinvest due to the sale of Cheniere Energy Partners and the sale of Interpublic Group, instead of buying the top 4 stocks in our 2 strategies, we opted for the top 5 in each strategy for a total of 10 stocks last week instead of 8. And I also really like the 5th place stocks too, Enterprise Products and PNC Financial. And because the high yield portfolio currently has less than 0.5% in tech stocks, for those that want to add diversification to this portfolio, I added to my site a list of technology-focused investments that provide income with yields from less than 2%, like Microsoft, to yields as high as 10 to 12%, all of which I either currently invest in or have invested in. I'll also tell you which is my favorite. Of course, the technology-focused investments with the higher yields don't have the chance to grow their distribution yields as fast as one like Microsoft or Broadcom. There's always a trade-off. Don't chase yields. One thing that's different about this higher yield strategy versus our dividend growth strategies on the previous slide is we usually only purchase 8 stocks, but this week is the first exception where we bought 10. And there's 2 strategies, as I mentioned before. Strategy 1 emphasizes a high dividend yield over dividend growth. That's perfect for investors in retirement or getting close. And strategy 2 still emphasizes high dividend yield, but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds. All right, so this week it's 5. The 5 high yield stocks we bought last week while implementing strategy 1 are Bristol Myers, CVS Health, PepsiCo, UPS, and Enterprise Products. And the 5 high yield stocks we bought last week while implementing strategy 2 are PepsiCo, Gilead Sciences, UPS, LyondellBasell, and PNC Financial. Last week's purchases have an average yield of 4.7%, with Lyondell coming in at the highest with a 7.1% dividend yield. Here's a look at last Monday's ratings for competitive advantages, management, and financial health. And on this slide, we see last Monday's grade for recent dividend growth and current yield, as well as recent dividend growth history. And in the last column, you can see the grades for dividend growth potential, which will be much lower than for the stocks in our dividend growth portfolio, which consists of stocks with usually lower yields, but a greater potential for excellent future growth in those dividend payouts. And here are our trade confirmations from last Monday for the high yield stock portfolio. We took the weekly deposit plus any dividends that we recently received, plus the proceeds from the sale of Interpublic Group and Cheniere Energy Partners, and there's a lot of proceeds to reinvest. And we reinvested the total funds into our top 10 stocks on Monday. Now let's talk about our 2 technology stock portfolios. Because my students love technology stocks as well as crypto and options, we started 2 technology portfolios just for fun. For the first time, on January 1st of this year, I funded a Fidelity account with $1,000, and we invested into only stocks offering products or services involved with certain technology themes. Unlike our other portfolios, we are not investing additional funds each week into this portfolio. We are sticking with the original $1,000 investment. The tech themes we built the portfolio around so far are artificial intelligence, cloud computing, software as a service, cybersecurity, and big data. This portfolio can invest in sectors outside of the technology sector as long as the company is connected to one or more of our technology themes. For example, both Meta Platforms and Google are in the portfolio, but are both in the communications sector, not the technology sector. So far, the portfolio has gained 40.9% in a little less than 12 months. In comparison, technology ETF with ticker symbol XLK is up 23.3% over the same time period, and the S&P 500 is up 25.5%. Best performers in the portfolio so far are NVIDIA at 179.8%, Broadcom, Pure Storage, Meta Platforms, Fortinet, SAP, and ServiceNow. And let's talk about our peer tech stock portfolio. Back in late April, we started a portfolio that only invests in stocks that are officially in the technology sector. Like the other portfolios, like the two dividend portfolios, we invest $12.50 each week into it and then boost that investment annually by the rate of inflation. Now, I hesitate to call this a portfolio since it's limited to only one sector, but it's been fun to follow. Since this portfolio started, it has outperformed the two dividend portfolios over the same time period. Now, this portfolio has been very volatile, once again showing the advantage of lower volatile strategies such as dividend investing for those that cannot stomach such large swings up and down. Now, some people can handle the volatile swings, so just make sure you pick an investment strategy you're comfortable with. So how is this portfolio different from the $1,000 tech portfolio shown on the previous slide? The portfolio on the previous slide is based on certain technology themes and therefore includes some stocks that are not technically in the technology sector, like Google and Amazon. So on this slide, we rate the top stocks for the week, but they must be in the technology sector. The average investment so far has been held for 112.8 days and has produced an average return of 11.43%. Using Excel's rate function, that's an annualized return of 41.96%. If we had instead invested our weekly investment into XLK, one of the largest tech ETFs, instead of 11.43% average return, we get an average return of only 5.49%. And that annualized return was 20.5%. And if you instead invested in the S&P 500, you'd only have an average gain of 5.9%, which is an annualized return of 20.4%. Note that all these stocks are higher quality, meaning they must have a quality ranking of B- or better. Also note that the ranking system used for these tech stocks may differ from the rankings we use to rate dividend-growth stocks because many tech stocks do not pay dividends. Therefore, in this ranking, we ignore the criteria that involves dividend growth, dividend payout ratio, etc. But we use a valuation methodology we discuss in class. It can be used on all large stocks, whether they pay a dividend or not. Now, so far, the stocks in this portfolio, about 7 or 8 out of 10, so about 70 to 80% do pay a dividend. So our top 4 tech stocks that we bought last week were Adobe, Applied Materials, Lam Research, and Synopsys. Of course, we bought all 10, but those were our top 4. So that's it for this week. Remember, I'm taking next week off for Christmas, so my next video will be in 2 weeks. I'll also take that time to put our technology portfolio on our website. So Merry Christmas and happy investing! Ho, ho, ho!